Control. When we're talking about control, budgets come to mind. And there's a lot of different types of budgets. We tend to think, oh, do you have an expense budget? Did you spend enough? Or too much? Well, let me talk about something you may not have thought about. You'll have a cash budget, how much you can spend in terms of cash, or the business will keep in terms of cash. We want to keep a certain level of cash in the business. Capital budget. How much money do we spend on depreciable assets? That budget is kept separately from an expense budget. Expense budgets are ones that show up on the income statement. As a manager, you may someday have a capital budget and an expense budget. You can't mix those two. If I'm underrunning expense, I can't spend it on capital. Why? Even though I'm spending the same amount of money in a year, it's because capital then becomes depreciating in the follow-on years and affects my income statements in follow-on years. Likewise, I can't take money out of my capital budget and say, well, I'm not going to buy that equipment. I'll spend it on travel and living or something like that. Can't do that because that affects the revenues and, well, not revenues, but affects your expenses and your net income in the current year. So those budgets will have to be kept separate. Now, we tend to think of spending money, but I might have a revenue target for sales. How much money am I going to make? How much money am I bringing in? I'll have a profit budget. What's my next expected net income for the year? Headcount. How much staff can I have? Can I hire more? Can I not hire more? I have to keep to it. Believe it or not, in terms of controlling, there was a point when Lucent did not know how many employees it had. That's nuts. You're clearly out of control if you don't know how many employees you have. Space, how much floor space do you have? How many buildings? How many office space? Production. These are just all different types of budgets that you might have. And we talked about the difference between expense and capital budgets. They need to be kept separately. Now, there's two types of budgets, two main ways that budgets get created. One is incremental. We've talked about incremental in the past. It means next little step. Well, an incremental budget is typically how the government does it. You take what this year's budget is and add a certain percent, and away you go. That's incremental budget. It's easy. Maybe that's why government does it. But it doesn't really reflect what's going on in the business. There may be areas that need more than others, and maybe some others shouldn't have as much as they used to have. Maybe they should go down. So zero-based budgeting is where you start with zero, and you make everybody come in and justify what they need in terms of a budget, in terms of money. Now, budgets are typically created top-down. CFO and the CEO will get together and they'll create a budget starting with an income statement and balance sheet and cash flow, and push those budgets down to the various organizations. Well, you might get down there and somebody might say, I can't make that much sales if you only give me this much in expenses. Okay? So you might start with top down, might go back bottom up. I can't do it. But then in the end, you have to reconcile those two. And eventually it ends up being, the final word is top down. People can play games with budgets. This is a big issue with managers, and which is why top-down budgets are sometimes done, because people don't like the game playing. But people would like to, if they're requesting, in case of a bottom-up budget, where people are saying, here's how much money I need, they start out high knowing that their budget's going to get cut. Well, it happens every year. They cut our budget 2%, so I'm going to ask for 5% more. Then when they cut it 2%, I'll really get 3% more. That's the kind of game playing that might take place by managers. Now, the book really doesn't talk about managing the budget. Any good manager can meet a budget. I used to have a boss. He said, if you can't keep track of your checking account, you can't keep a budget. Well, people don't use checking accounts that much anymore, but the principle holds. If you can't manage your own money, you're not going to be a good manager. like to spend a whole lot of time on this, but not really able to in this format. But you want to track how much shall we spend actually this period versus what is our budget. How much, what our budget was X this month, what did we really spend? How are we on track for the year? Well, this may have been June, but are we on track so far this year for 6 months? As a manager, you then want to look out to the end of the year, or sometimes the month or the quarter, depending upon what your goals and objectives are. But you need to project out. Am I going to make my numbers for the period? And compare your projection with the budget. The earlier you find problems, the earlier they can be fixed. If you wait and have a big problem and you wait till the end, you can't fix it. But you can at least have a shot if you find and address problems early on. Now, financial controls. How do we control things? From a financial standpoint, managerial accounting, ratio analysis is a big way. Talk about intro to business, you had this in managerial accounting. What is my return on sales? What is my operating margin? What is my contribution margin? What is my return on sales? Did I say that already? Return on equity. All these sorts of things. And I compare those relative to the competition. I benchmark them. Benchmarking, remember, is a term where I compare my business to another. So, what does my inventory turnover ratio look like relative to my competition? Am I slower? Am I not turning over my inventory as fast? What can I do? Now, in terms of financial controls, audits are important. Right? You want to have internal audits. Take a look at your own business yourself. What am I doing right? But external audits are important. Have somebody else come in. Have them look at your books. Right? Have them look at the way you're doing your processes. Maybe you can do things better. Maybe there's issues like fraud going on that you need to be aware of. You won't necessarily find those under internal audits. External audits, there's the potential for conflict of interest. Enron, which is a name that will go down in infamy, hired Arthur Andersen to do its accounting and do its external audits. Well, Arthur Andersen was also doing consulting work for Enron. So the auditing people didn't want to make Enron upset or create any problems because then they would lose the consulting business. Big conflict of interest. And since then, they had to split the business up. A business that does something really, really different is Bridgewater Associates. Bridgewater Associates, I don't know of any other business that does this. They have 2 accounting departments, and they both do exactly the same work. And at the end of the day, they compare all their answers and their data. If they don't match, there's a problem. That's a very unusual but creative way and shows how important some of this stuff is.